The 21st century has witnessed a fascinating power shift. On one side, the United States stands as the world's dominant superpower, a position it has held since the end of World War II. On the other, China, once considered a sleeping giant, has awakened and risen at an astonishing pace. China's economic transformation is nothing short of remarkable. In just 4 decades, it has evolved from an agrarian economy to a global manufacturing hub, producing everything from everyday consumer goods to cutting-edge technologies. Meanwhile, the U.S., driven by innovation, capitalism, and military power, continues to lead in key sectors like finance and technology. However, this rise isn't just about economics. It's about influence, values, and a vision for the future. This rivalry isn't simply a story of two powerful nations, it's a battle for global dominance, one that carries implications for every corner of the world. The growing tension between the U.S. and China has been brewing for years, driven by contrasting ideologies, economic ambitions, and geopolitical strategies. The U.S., a beacon of capitalism and democracy, views itself as the steward of the global order. China, on the other hand, operates with a centralized government that wields immense control, blending state capitalism with authoritarian rule. These differences have sparked numerous flashpoints. Trade wars, like those initiated during the Trump administration, are a prime example. Tariffs on Chinese goods and restrictions on key industries, such as technology and energy, reflect the U.S.'s attempts to curb China's rapid ascent. At the same time, China's global ambitions are clear. From its massive Belt and Road Initiative to investments in critical infrastructure worldwide, it aims to position itself as the heart of a new economic order. This assertiveness, coupled with its diplomatic and military maneuvers in regions like the South China Sea, challenges the U.S.'s traditional dominance. These tensions aren't just diplomatic, they affect global trade, technology, and even cultural perceptions, setting the stage for what some fear could be the next Cold War. The U.S.-China rivalry presents a wide spectrum of potential outcomes, ranging from collaboration to full-scale conflict. The most optimistic scenario is one of strategic competition without direct confrontation. In this scenario, both nations could focus on outpacing one another economically and technologically, fostering innovation without risking global instability. However, a more troubling possibility lies in escalating conflicts over contentious issues such as Taiwan, cybersecurity, and trade imbalances. A miscalculation in the Taiwan Strait, for instance, could trigger a regional military conflict with global repercussions. Similarly, ongoing cyber attacks and espionage could deepen mistrust, further isolating the two powers. In the worst-case scenario, these tensions could lead to a military clash, reminiscent of past great power rivalries. The economic interdependence between the two nations might act as a deterrent, but it's not a guarantee. Geopolitically, this struggle could redefine alliances. Countries may feel pressured to align with either side, reshaping the balance of power across Asia, Europe, and beyond. Amid these possibilities, the global economy hangs in the balance, with supply chains, trade, and investments vulnerable to the ripple effects of any escalation. Periods of geopolitical tension, while fraught with uncertainty, often open doors for strategic investors. As the U.S. and China navigate their rivalry, certain sectors and markets are poised to benefit from increased spending and shifting priorities. One area ripe for investment is defense and cybersecurity. Governments worldwide are bolstering their security budgets in response to rising threats, creating opportunities in companies specializing in military technology, surveillance systems, and cyber defense. ETFs tracking the aerospace and defense sectors could also offer diversified exposure. Another promising area is semiconductor manufacturing. As the U.S. and China aim to reduce dependence on each other, significant investments are being funneled into chip production. Firms like TSMC, Intel, and ASML stand to gain from this decoupling. Investors may also consider commodities like rare earth elements. These materials, critical for advanced technologies, could see price surges due to geopolitical disruptions. Finally, global uncertainty often drives capital into safe haven assets like gold, government bonds, and the U.S. dollar. Diversifying into these instruments can help mitigate risk during volatile times. The key to navigating this landscape? A sharp eye on geopolitical developments and a portfolio aligned with both risk tolerance and long-term goals. The evolving dynamics between the U.S. and China signify more than just a political contest, they mark a profound transformation of the global order. For investors, understanding these shifts isn't just advantageous, it's essential. By aligning strategies with emerging trends, diversifying portfolios, and remaining informed about geopolitical developments, opportunities can arise even amidst uncertainty. This is not a time for fear but for strategy. Whether through defense, technology, or safe haven assets, the investment landscape offers ways to thrive during turbulent times. As we conclude, the key question remains: are you prepared to adapt to the changing tides of global power and position yourself for success? Let's discuss this further in the comments. What's your take on the future of US-China relations?